Yeah, my name is Brien Lundin. I do a lot of stuff. I write Gold Newsletter, which is the oldest precious metals and mining stock advisory in the whole entire world. I also produce the New Orleans Investment Conference, which is the oldest investment conference in the whole entire world and has spawned a number of friendly competitors, including the event that you're at. Do a lot of stuff in the industry. I also help organize these gold cruises that Sean just mentioned, and as he said, we're going to be doing that at the end of May, early June, 10 days throughout Europe with Sean, with Rick Rule, with Winston, with Byron King, Mike Bernick. Really incredible event, so please check into that. But let's get started with my presentation, gold, following the plan so far. The plan's been pretty well laid out for gold over the last couple of years. We bottomed in December of 2015, went into the year-ending rate hike of the Fed, which was the first rate hike from the Fed. Gold slid going into it, and it pivoted right on that rate hike and took off. Last year, it looked very similar. Gold slid down going into a year-ending rate hike. We were talking about that in Gold Newsletter, said this is a real opportunity. Sure enough, it took off. We had another multi-month major rally in gold, a bit different than 2016, as we're going to see in a minute. Going into this fall, I screamed at the top of my lungs for months in the newsletter at conferences that this was likely to be a third occurrence of this pattern, that gold would slide going into the year-ending Fed rate hike and rally off of that. As we're about to see, it did just that. This is the longer-term bull market. As you can see, we went up till 2011 and then had a long slide out of that uptrend. In fact, that was the longest bear market in gold history, the longest and worst bear market in gold history. Not saying a lot, of course, because gold was only freely trading since 1974. But that was the most painful market, bear market we've ever been through. Last 3 months, we've seen what I was talking about. Let's see if this laser pointer, yep, works. We slid into the Fed rate hike. Right there is the Fed rate hike, and there we go up. Now, again, I was telling people, and a number of my colleagues in the industry told me to shut up already, but I kept saying it over and over, this was going to happen again. And sure enough, it did. And the whole point here being don't fear the Fed. And this all kind of revolves, as I'm going to go into a little bit more in this presentation, where the hot money goes and where, how it invests on periodic themes. Going into a Fed rate hike, traders go long the dollar and they short gold. And this has happened over and over again. This is the December 2015 rate hike. Here we had that nice long bull market till mid-year in 2016. Then we had the election, and we had enthusiasm over, for stocks over Donald Trump being elected. We had a lot of worries for other reasons, but then gold sold off going into the Fed's next year-ending rate hike. And then it changed a bit. Going into 2017, we had a bit of a different environment. The Fed said we're going to hike rates 4 times this year in 2017. Turns out they weren't able to do that, but still we had kind of a mini repeat of that pattern. Every Fed rate hike here, marked by these red arrows, marked gold going down into it and then up. This one was not quite as exact, but still we had a nice rise in going into summer, right after that Fed rate hike around June. And then we slid back in, and this is the last Fed rate hike, last December, and this is where we've gone so far. So once again, the pattern repeats. Going forward, it's not quite as clear, but we'll get into that in a moment. These, the gold miners have responded. That's the GDX. Here's the GDXJ, the junior gold miners. That's responded, same pattern, a bit of leverage, but in general, as a group, the mining stocks have not yet offered the kind of leverage that we'd like to see off the gold move. We haven't seen silver offer the kind of leverage off the gold move that we would like to see in a longer standing, more consistent, more monetary based type of rally in gold. So we're not quite there yet. I think that generally we've not had the kind of sustained long-term rise in gold yet to get that greed factor going. We're seeing the cryptocurrencies originally stole a lot of risk capital from the gold market, a lot of hedging capital for the gold market, a lot of greed capital from the gold market. We're seeing some money come out of that sector, but I think it's going more into the physicals and not yet into the equities. So why is gold rallying? Now, Sean touched on this a little bit, and here's the answer: because the dollar is falling. Now, Sean highlighted the dollar-yen trade, and that is very close. It does mirror what I'm about to talk about. He also warned against using the dollar index, which is what I'm going to use right now. So dollar index, this is a bit hard. This actually goes back to 2014, but you can see generally there's a correlation when gold is the bottom line, dollar index is the upper line. There's generally a correlation. When the dollar is going up, gold goes down. This is not a hard and fast rule. It's something that kind of naturally follows. Gold is priced in dollars. So naturally, dollar goes up, the price of gold will go down. The dollar is also the world's reserve currency. So the gold is a reflection of the strength or the outlooks, the sentiment for the dollar. So naturally, when the dollar is strong, gold will go down and vice versa. But it's not hard and fast. There are periods when the dollar is going up and gold is going up, typically in times of safe haven buying. But generally, there's a correlation there. However, over the last couple of years, that correlation has gotten extremely close. And what I tell people is, we spend a lot of time analyzing the gold market. We look at commitment of traders reports, you look at Chinese demand, we look at all this stuff, trying to figure out where gold is going. You look at the correlation between the dollar and gold and consider that the dollar is so much larger. The dollar market, the Forex market, is so much larger than the gold market, the tail is not going to wag the dog. So if you want to know where gold is going, look at where the dollar is going. Let's look at that correlation. This is a chart I took from Martin Murenbeld's latest report. He does an outstanding job statistically and graphically depicting this. He has a wonderful chart here, and he shows the correlations. You can see that this is an inverse of the dollar index against gold, and it follows very closely. But it actually varies from year to year. In 2011, it was fairly close. You had a correlation of minus 0.71. A correlation, a negative correlation of 1 would be absolutely perfect. 0.71 is pretty good. Dropped off in 2012, 0.54. Dropped off 2013, 0.59. 2014, it spiked to 0.85. But the last 2 years, it dropped off again in 2015, 0.63. But in this bull run, 2016, 2017, that negative correlation tightened up considerably. 2016, it was minus 0.85, 0.83 last year. To date, it isn't quite as close because there's just not enough data. It's not statistically accurate yet. But again, 2016, 2017, we're trading off the dollar. You need to figure out why the dollar is dropping, how long it will last. That's going to determine what's going on for gold. This is a chart that I took from Jeffrey Gundlach's latest presentation and end-of-year presentation at Double Line Funds. Gundlach's one of the smartest guys in the business. Really, really brilliant. He's got one of the best, if not the best, track record of anyone over the last, well, as long as he's been in the business. And what he's done here is tracked the market implied rate for the Fed funds rate, which is the blue line, and plotted it against the dollar index. Now, the implied rate is what the market sentiment, what the market is betting the Fed funds rate will be in 2019. So this is 12 to 24 months out. And you see how closely this correlates to the dollar value. So what's happening is big Forex traders are not trading on today's headlines or yesterday's headlines or even tomorrow's headlines. They're looking 12 to 24 months out, and they're placing their bets on the dollar. And what they're saying here is the dollar or the Fed funds rate, the implied rate, is not going to be as high as everyone thinks. There's a number of reasons behind this. Interest rates can never be normalized. Forget about that. They'll never be normal again. for decades without some kind of economic catastrophe because the debt loads are too high. You just can't have 4, 5, 6, 7% interest rates anymore without cratering federal budgets. But the key here is that the big money is driving the dollar according to where it thinks the Fed will be and where the Fed will be on a relative basis to other currencies going forward. So we'll boil that down a little bit more going forward. But right now, let's see, where do we go from here? A little technical information here. Dollar index, Bollinger Bands. I'm not a technical analyst. I just stand up in front of crowds and pretend to be. But I'm really not. I'm not much of a technical analyst. I rely a lot on a friend of mine, Ron Grease, at the Chart Store, thechartstore.com. He does a weekly chart blog that's outstanding. And this pattern that he's outlined here shows that the dollar index has to hold a line of about 90.50, 90.50. That's a major support line, and after that, it implies a much more severe drop with an 80 handle. Right now, I believe the dollar index closed yesterday at 90.66, and it's been bouncing around just a few points around this level. So we have a risk here for the dollar of going much lower if it takes just a little bit more of a leg down. Now, one of the things that Ron does is this 14-week stochastic, which has been very good for gold and lately very good for the dollar in predicting where the momentum is and how long the trend has to go. You can see here that the dollar had peaked close to that 80 level and is coming down on a downtrend. Now, each of these markings here, these ticks, is about a year, and it takes about 6 months for one of these up and down trends to reverse. And we're probably about 2 or 3 months into this latest dollar momentum trend. So I'm looking at this, I'm roughly gauging that we still have some dollar weakness ahead, probably 3 to 4 months, perhaps as much as 6 months, depending on whether that bottom gets rounded or not. And this is pointing to a kind of a similar pattern that we had the last couple of years. Weakness in the dollar, strength in gold going through about the first half of the year. And here we see in gold that we've bottomed, and this is something we were following in Gold Newsletter as well, and pointing to a bottom right around the end of December, which happened, and now we're going on an uptrend. Depending on how rounded that top is, depends on how it will determine how long this rally lasts in gold. As you can see back here in 01 through 011, that was a huge, huge bull market. 01 through 07, then 08, 09 to 011. Huge bull market. Tremendous money was made by being in the sector, by being in companies like are out there during this big run. That had rounded tops or lengthy tops in the stochastic. Then we went into the long bear market, and every bit of upside momentum we had immediately turned. 2016, we had more of a rounded top. 2017, we had a bit of up and down choppiness. So what happens here, how long that momentum stays at an elevated level, will determine what we do in 2017, whether we're going to have a 2016 type of a run or a 2017 type of a run, but generally it's pointing to a positive environment for gold for the first half of the year. Again, Bollinger Bands, you look at this through that bear market, or actually through 2016, which is right around here. Every time the Bollinger Band hit that top, it stayed up there around a little bit of time, and we had some extended uptrends. Here, you can see whenever that Bollinger Band hit 100 in 2017, we reversed, and we had that choppy nature, that stair-step pattern going up. Again, 2017 was a bit different than 2016, yet to be seen what we're going to have this year. Copper is spending some time backing and filling. It's actually regaining some momentum. Copper looks good right now, but I don't think we're going to have the kind of explosive or very impressive runs that we had earlier this year and late last year. But it doesn't look bad. I just threw this in here because I thought it interesting. Ron had drawn an inverted head and shoulders pattern with an extended right shoulder. that actually projects to a oil price in the mid-70s, which of course would have better implications for commodities. Now, here this chart is again. Sean said he was embarrassed to put this chart up because he saw a couple of speakers yesterday had the same chart, and I was mortified to see him put it up with that announcement because I have the same damn chart again. But, you know, I think Sean put it well. These are big, long trends. I agree with Sean. I do not, as overvalued as the U.S. stock market is, there are a lot of reasons for it. Yeah, a market can be overvalued longer than you can remain solvent. It can have some momentum going forward. The thing that's going to trip it up is going to be either a blow-off of this enthusiasm or some economic data in the U.S. that's pointing toward a recession. I looked through Gundlach's latest report, and he's, as I said, he's a brilliant analyst. He doesn't see any signs of a recession for the next 6 to 12 months. And looking at a lot of the numbers out there, I would have to agree, but the markets are predictive mechanisms. So I'm thinking we're going to see some shifts in market momentums around mid-year. So this stock market could go easily in this kind of momentum to mid-year, but I think everything's going to be reassessed then. If we do have a recession, what does that mean for commodities? This chart by Gundlach shows that not only is it not bad for commodities, but that typically there is a huge run-up in commodities in advance of a recession. Only one instance in this case where that did not happen. So it's not that the two things don't necessarily exclude each other. If we're going to have a recession in the U.S. a year, 18 months, 24 months out, which from a cyclical pattern we most likely will, then we could have a really nice run in commodities going into that. What could bring it on? What else could bring on a correction in the stock market? What could bring on an economic slowdown? Well, we have shrinkage in Fed assets. Here we have the Fed is now contracting right now, and there's going to be about $1.5 trillion of liquidity sucked out of this market. If you look at the correlation between the Fed's balance sheet and the S&P 500, it's about 98% since the 2008 credit crisis. So this is what has really pumped up the markets. Now we have tax reform, so we're going to have a bit more momentum behind the equity markets, but this is what's doing it, and it doesn't end there. The ECB, the Bank of Japan are behind the Fed, and this is what's driving the dollar down. I told you I'd get to this. The Fed hiking theme, investment theme, has already happened. When the Fed started to hike rates, started to normalize, started to tighten its policy, roll off its balance sheet, the end of that trade came for the hot money out there. That's these big, huge pools of liquidity that slosh from market to market. They're out of the dollar now. The theme is that the ECB, the Bank of Japan, are just beginning their tightening. So that's where the money is going. That's the next bet, and that's what's driving the dollar down. And gold's being carried along. Big picture, two paths ahead. We could have continued economic growth. The Fed keeps raising rates as scheduled, but with an upper limit of around 2.5%. The result, low real rates, rising incomes, inflation pressures are rising. That's all bullish for gold. The other big path that we could have is some economic weakness that prevents the Fed from continuing its normalization process. That result would be more economic accommodation, more QE, and gold absolutely explodes upward. Starting to run out of time, so I'm going to go over a couple of these things really quickly. Gross federal debt, people don't realize the trend rate of that since 1900 is 8.7655%. That's the trend rate growth of the U.S. federal debt year over year since 1900. At this rate, if it continues that rate, the debt's going to be $25 trillion by 2020, 2 years from now, and $30 trillion by 2022. In fact, if Donald Trump continues the record of his predecessors and ends up doubling the federal debt will be $40 trillion by the time he gets out of office if he makes a second term, 2024. Purchasing power of the dollar. This chart starts in 1965. Let's see if you guys can duplicate the success of past audiences. What happened in 1965? Anybody? Exactly. They took silver out of the U.S. coinage, and since then the dollar has lost 87% of its purchasing power. Roman emperors, a number of Roman emperors were killed because the Roman denarius was devalued less quickly. We have not seen the repercussions of that yet. Real gold, today's dollars, the 1980 peak, nominal peak of $850, you would, in today's dollars, will have to get to $2,700 about to equal that peak in 1980. Now, if you really want to look at some upside numbers, this was a table done by Incrementum AG in Switzerland. They do a wonderful report in Gold We Trust, an annual report. If you had a 20% backing of money of zero maturity in the U.S., that would equate to a $2,700 gold price. If you had a 40% backing of, say, M2, that would necessitate a $20,000 gold price. If you were to back the dollar 100%, it will never happen. By M3, that's a $70,000 gold price. This is just a sign of how many dollars are out there, how much liquidity is out there relative to the only real anchor of monetary value in world history, gold. So plenty of upside, plenty of opportunity, both in the metals and gold and the companies out there in the exhibit area. That concludes my time, but we will have, after we go through these company presentations, we will have an opportunity for some Q&A across the hall. But I do want to get started on these company presentations. All of these are companies I'm very familiar with and very positive on and have recommended in Gold Newsletter. The first up